likely to sell or flip a new offering, making the discount offer worthwhile from the firm's perspective. So one of Greenblatt's favorite strategies is to identify a company trading at a discount to its fundamental value that also plans on making a rights offering that's like a double discount. Risk arbitrage, also known as merger arbitrage, is another tool in Greenblatt's investing toolbox. Let's say that before a merger deal is announced, the target company is selling at $40 a share. And the next day, a bidder offers to buy it for $50 a share. Because there's a chance the deal could fall apart, the company's shares might still trade at $48 or $49 for a while, until it's clear that the deal will go through. The size of the spread also relates to the time value of money, since it could take several months for the deal to close. When the deal does close, the arbitrage trader, the ARB, will capture the spread of $1 or $2. However, if the deal falls apart and the stock falls back to its $40 pre-merger price, the ARB trader would lose $8 or $9 a share. Greenblatt is not a big fan of a regular merger arb trade, but he does get excited about something called contingent value rights, or CVRs. These are common in the healthcare and biotech mergers. Let's say a bidder is unsure of the value of a future drug in a biotech company's pipeline. Rather than having a potential deal break down, the two parties might agree to issue a CVR, or contingent value right, tied to the drug in question. This way, if the drug is a blockbuster, pre-merger shareholders are entitled to a premium beyond the deal price. Now, CVRs often generate their own trading market, even though they're often small in value compared to the original stock. And a lot of investors dump their CVR rather than waiting to see what the outcome is. For Greenblatt, this can be an opportunity, bringing to mind the old saying, one person's trash is another person's treasure. Greenblatt became famous in the investing community for his concentrated portfolio of special situation stocks. A good example is the spin-off of Marriott some years ago, involving the separation of the company's hotel management business from its hotel ownership. Back in 1993, the hotel management business was spun out into a new business called Marriott International, which initially was believed to account for about 85 to 90% of the value of the combined firm. In turn, the hotel ownership part of the business, which had a lot of debt, was rechristened Host Marriott, and it was expected to account for around 10 to 15% of total value. Most institutional investors wanted to keep the management business and sell the hotel real estate business. First, they thought Marriott International was the better strategy. And second, they thought that Host Marriott could end up being too small for them to hold. But Greenblatt thought better. He noticed that the parent company's chief financial officer, Stephen Bolenbach, who masterminded the spinoff, was to become CEO of the Host Marriott part of the business, supposedly the laggard piece of the company. And the Marriott family was retaining a 25% stake in the hotel ownership company that Bolenbach planned to lead. Fast forward to the time when the spinoff was executed, and the stock of the new Host Marriott business initially plunged from the pressure of institutional selling. But then it tripled from this depressed value only 4 months later. Greenblatt provides some specific advice to further improve your results. He suggests looking for businesses that have institutional investors, such as pension and insurance companies, that they don't want, especially if they're too small for the big institutions to own. Greenblatt also says to look at the behavior of corporate insiders, whether they're buying or selling. They know the business best. But again, as we saw with both Walter Chrysler and Joel Greenblatt, your investing philosophy and approach should match your personality, skills, risk tolerance, and resources.
The financial information provided in these lectures is for informational purposes only and not for the purpose of providing specific financial advice. You should contact a financial advisor to obtain specific financial advice. We hope you have enjoyed these lectures from the Great Courses. Our courses are available online or via the free The Great Courses app for smartphones and tablets, available on the App Store or Google Play. View our full library at thegreatcourses.com, or as always, you can call our customer care representatives at 1-800-832-7232.